Can the ECB sell the markets on its inflation fight, or is it going to sink the euro instead? That and more today on Macro Money. Welcome, everybody. This is Ilya Spivak, head of Global Macro here at tastylive. And after that fireworks imbued response from the Fed, we went up, we went down, we see it all over the place. We focus on the ECB and the euro and what it's going to do here as the other big central bank comes and has something to say. We, of course, are going to break down exactly what's going on and how it might impact markets. So watch as we go through here. But the key question to have in mind as we do is, can the ECB sell it? Can they convince the markets that there is a credible effort to beat inflation underway? And if they can't, what are the consequences? Because right now, the market is dubious. And you can see it right here as you look at inflation expectations relative to what is actually going on with inflation itself. So what you're looking at on the screen here is Eurozone CPI, the Consumer Price Index, the target that the ECB is aiming at, bringing to 2%, now sitting at 6.1, having come down significantly, of course, from the tops north of 10, but nevertheless well off target. And overlaid with that, the German 10-year break-even, that's the difference between nominal and real bond yields. That differential gives you the residual of the bond market's inflation expectation. And the five-year inflation swap, it's a 5-year view of inflation expectations. And you can see here they're a little bit north of the 2% target, but close to it. That's hardly the point, though. They're trending in the wrong direction. So it's one thing to say, oh, in 10 years, 5 years, the ECB looks to be on target or so. And there's surely a time premium there. If there were a liquid 2-year break even or a liquid 2-year swap, maybe we could see something that's a little bit more clear as going to 2% within the actual projection period that the ECB would like. But it's certainly not trending in the direction that the ECB would want. The direction of travel for inflation expectations seems to be higher, whereas what the ECB would like is for it to be going lower. So, what's going on here? Let's take a look at the breakdown in inflation and see why it is that the market doesn't think the ECB have their hands around this. Well, it'll be a familiar picture. So here is core holding up fairly steady here at 5.3% and not really going very far. There is headline coming down to 6.1. You can see that there in the solid line. Now, how did it get there? Well, the first bit is, of course, energy. You can see that little yellow bit on the bottom there, showing you that at this point, energy is actually a disinflationary force. It's actually pulling inflation lower at this point. And you can see why. Here's a breakdown of the top exports from Russia as relative to overall commodity prices to give you a sense. You would think that with a war going on right on Europe's doorstep and with a disruption to key Russian exports of energy, you would have a better story on energy prices. But consider crude oil down 35% year on year as of today. Nat gas down almost 75% year on year as of today. Overall commodities down about 22, so significantly less than energy prices. And that, we've argued here on Macro Money, is because Russia is flooding the market. They want to keep market share, and so they're flooding the market with that which they can still sell, given the sanctions regime. They do not want to lose market share while they're in this lockdown, and they're trying to win this war, as difficult as it has proven to be for them. So they are trying to ship as much as they can, and the market is really well supplied with energy here. Hence, prices are aggressively lower. And so it's not surprising then that the energy component is now really one of the major drivers of disinflation. The other one that's been squeezed significantly is the goods component. You can see it was a much bigger part of inflation back in the start of last year and has been squeezed to almost nothing. And that comes to us courtesy of the Fed's efforts. But before we jump into that, let's quickly just write off the list here the food inflation component. You can see it's been fairly steady, and much of that seems to be this bit right here, the yellow bars there, Eurozone CPI. Then in the red, you can see energy prices coming down. We just figured out why that seems to be the case. But soft commodities holding up. And of course, that speaks to the price of food. You can see they're actually trending the other way. So once you sort of balance what's going on here, the price of food, to some extent, also the price of petroleum products because of fertilizer. And so you have kind of a steady setting here as you parse these things, but it's not a big wedge. It's not a big component of what the CPI story is. So likely that isn't the deciding bit here, though perhaps it speaks a little bit to the strength in the consumer part of the story versus the global trade part of it. And that, of course, is what's going on with the goods side. This is why that goods component is getting so squeezed. Take a look at what's been occurring here. So needless to say, we know the Fed has been raising rates and leading other central banks to do the same, with the idea that we need to bring inflation to heel. And indeed, as rates have gone up in the orange there, the Fed's near-term first Fed funds future implied rate, so essentially where the borrowing cost for dollars is targeted near term, and that just gives you a sense of the overall structure. This is essentially the baseline for all other interest rates, not just in the U.S., but really the world over, because the dollar is such a ubiquitous currency that borrowing costs in dollars really reflect borrowing costs for economic activity internationally. And so it's essentially the entire pie here that the Fed is shaping. And you can see that on this chart, because as you see the funding costs in dollar terms going up, you also see a broad-based slowdown in global trade volumes. The dark line there, the sum of global imports and exports put together, and you can see volumes decelerate as rates go up. That's that goods component. So you're slowing economic activity, that's understandably slowing demand, at least at the goods part of the story. And you can see the influence on CPI. So there's the Bloomberg Commodity Index, which we saw before, going lower. There's that global trade volume there. There's the Fed rate, and there's the impact on Eurozone CPI. You can see once you lag CPI to get rid of the effects of the data showing up these forces later than they actually occur in the real economy, for obvious reasons. It takes time for policy transmission to occur. It takes time for the price of goods to filter into end consumer inflation. And of course, it also takes time to compile the data and actually release it. So not surprisingly, a meaningful lag there, a 5-month lag. You can see then that once you look at that relative to these Fed-led efforts to slow growth, you can see it is indeed helping to drive disinflation. And it is, in fact, why we seem to have that orange wedge in the goods component shrinking significantly. The PMIs tell a similar story. They also, however, tell a story about those parts of the equation that haven't rolled over. So the slowdown in global economic activity, in particular on the trade side that we just looked at, consider that the manufacturing PMI line here, which, as we've discussed before, PMIs run on a logic that is based around 50 as the center line. So at 50, the given sector we're looking at, manufacturing, services, or the composite, is neither growing nor shrinking. Below 50, it's shrinking. Above 50, it's growing. The further above 50, the faster the growth. The further below 50, the faster the shrinking. And so you can see here that for the manufacturing side of things, and this is a major part of the growth engine in the Eurozone. In fact, Germany, the largest economy in the region, was only surpassed in relatively recent years by China as the top global exporter. And of course, China is orders of magnitude larger in terms of population, in terms of geographic size than is Germany. And yet Germany was outperforming them on the export side until relatively recently in terms of sort of cumulative standing. And that really speaks to how important that is as an engine for Eurozone growth. You can see it is seemingly dying on the vine here, manufacturing shrinking and at an accelerated speed to really tell the story of this global slowdown, where you're still getting quite a bit of resilience, though we ticked lower in the last set of these numbers, is the service sector. This is the largest component of overall GDP growth, and therefore also the composite. That service sector is holding up the composite reading because, of course, it is a much larger part of the economy than is the manufacturing sector, no matter how big it is in the global sense. And so that really speaks to what we are seeing here as the biggest wedge in this inflation story. That big, dark area representing services, excluding food and energy. That's the problem. That's the part that the ECB needs to get down. You can see it has only just started to tick lower a bit, and is, from the looks of it, very much the reason why that core number is not really declining faster, why its incline heading south is modest at best. And so this is really where the ECB seems to be losing the market's confidence. Can it get this down? And the question then, of course, is there significant pain? Has the ECB done enough? Has it tightened enough? Because as we just saw from the PMI data here, we still are looking relatively resilient. We're looking at a composite index that roughly lines up with about a year ago, having recovered from weakness below 50 toward the back half of last year. So it would seem that growth is actually quite resilient. What's more, it's quite resilient in the face of a relatively tight setting for ECB monetary policy that the market is nevertheless questioning as effective. That would seemingly suggest that the ECB has more room to act. You can see that right here. So in the red is the financial stress index from the Office of Financial Research. That's within the U.S. Treasury Department. This is a global index. It captures not just U.S. liquidity conditions, but world liquidity and credit stress conditions. Obviously, as we've just mentioned, with the US dollar being so ubiquitous, that's often the same thing. But nevertheless, you can see here that as the Fed really starts to gear up its rate hike cycle toward the middle of 2021, financial stress in anticipation of a higher set of borrowing conditions starts to build. So too, you get a tightening in Eurozone financial conditions. The ECB, of course, joins the rate hike fray soon after the Fed and is helping to move this along. And what's really interesting here is not only are you getting this tightening of financial conditions, you're also getting, at the onset, a widening of the spread between Italian and German bond yields. A widening that then stops going into the end of last year, just as overall credit stress eases. And consider that it's moving even though we just had a banking crisis, even though there was certainly a hiccup along the way. This is now down to the lowest level since we've seen since the back half of 2021. Now, why is this important? Every time that you have a conversation about ECB tightening, this is perhaps why the market could be questioning the ECB's mettle, you start to have a question of, can they actually afford to do this in an environment where there is still a significant debt mismatch between the various members of the Eurozone? If you were to raise rates, then certainly wouldn't be a big issue for Germany and its very modest debt load to finance it at higher rates, but it would be much more problematic for a country like Italy, representing the more debt-laden parts of the currency bloc. Of course, those very same countries that gave us issues back in 2010, 2011 with the Eurozone debt crisis. So, not surprisingly, a significant concern here that if rates go up in a hurry, countries like Italy, as the sort of largest of the troubled bunch, and the most important to overall Eurozone stability as the third largest economy in the bloc, that they're going to have an issue paying their debts, which are sizable. And you might start to run into default risk there, or at least significant funding stress. And that what this will mean is, again, regional instability and some kind of crisis, as we saw, again, in 2010, 2011, running into 2012, when then ECB President Mario Draghi famously said, we'll do whatever it takes to safeguard the euro, and the market finally seemed to kind of let up on the stress, understanding the ECB will ease and ease and ease until it papers over any funding stress with enough of a pile of money. What you see here, incredibly, is this was a concern along the way toward the current setting for financial conditions. And as those financial conditions anchored, even though they've now anchored at the tightest since the 08-09 crisis, there's quite a bit of tightening that's being applied in the Eurozone here. Once the travel stopped and that blue line that you see there started to kind of anchor around current levels, the measure of credit stress started to ease off, the measure of the funding difference and the potential for sovereign risk within the Eurozone started to come in. That Italy-Germany spread started to narrow, reflecting less of a risk premium on lending to Italy versus Germany. So the ECB seemingly has everything it needs to do directly in front of it. The markets think that they need to tighten more. The structure of inflation seems to suggest that only slowing the economy is going to achieve what needs to happen here. Tightening is occurring in a way that isn't seemingly kicking over any sort of sovereign risk crisis. So the ECB ostensibly has a path toward hiking. And indeed, if we look at the baked-in expectations for this meeting and the next several going into about the middle of next year, just a little bit less, it is in fact a hawkish path. So what we're looking at then is a situation where we have a very, very clear sort of setup for this coming meeting. So a situation where we are almost fully baked in for a hike. We can see here 95% chance of an increase, and the situation already baking in 24 of the 25 basis points that the ECB is seen doing. As you go into July, you can see already a 75% chance of a further hike baked in there. So you can see the implied rate delta not quite at 50, but almost 44. We get there and see that hike fully baked in by September. You can see there you're at already 56 basis points, but then you stop. You don't get any further than that. At that stage, you're already in a scenario where the peak has been reached, and you already have a situation where there is seemingly something of a cresting. Now, the key that we seem to be looking at here is that if inflation expectations are moving higher as this is going on, then the upshot seems to be that the market doesn't believe this to be sufficient. And therein, seemingly, is the main concern, that as the market looks at all of this, what it's not finding is that all of these rate hikes that we are currently envisioning are actually going to get the job done. If that were the case, then we would be seeing the market respond accordingly on inflation expectations. And as we saw right here, that's clearly not what is going on. Inflation expectations are, as a matter of fact, going the wrong way. And so the question then becomes, well, how is it that there seem to be all the ingredients for tightening, but looking at the current rate structure, it's just not showing up? In fact, if we look at the yield curve as it presents itself, we can see that there's the current curve. You can see it's almost completely unchanged from a week ago. It is a little bit wider as compared to the last ECB policy announcement at the beginning of May from the 6-month mark onward. But at the front end here, 6 months forward, it's completely locked in place. So the markets are looking at these inflation expectations and they're saying the ECB isn't going to do anything about it, at least not in the near term. Yes, we might not jump to cuts as quickly as previously thought. It'll be a little bit more of a gradual climb down from the cresting that we see here 6 months out from the current setting, which, by the way, if you take a look at, again, the inflation expectation math as it factors into policy meeting adjustments, let's consider, once again, the peak in rates here seemingly in December. So that's 6 months from now. Looking at December, you can see there is 2 hikes baked in, about a 28% chance of a third. Rates peak at 3.72, somewhere between October and December. And then come January, you can see that there's already a climbing down, such that by, let's call it March, April, you've already shed at least one of these incoming rate hikes. So we're already at 3.48 come April, so close to and under 3.5, having arrived at 3.75. So at that stage, it looks like we're already going the other way. So why is this? Why is it that the market is thinking that the ECB isn't going to do anymore? And why don't they give them credit for what they've done already? Well, take a look at what's going on with economic growth, which appears to be aggressively unraveling. So we do have, as we just saw, only the start of a rollover on the service side. Here's the PMIs again. You can see it started to dip, but is only just starting. Whereas if you look at how economic data is performing relative to expectations on a day in, day out basis, you can see it is now aggressively underperforming relative to what market baseline is set to. This is, of course, from an average or a median, depending on the numbers that you look at and depending on the data source. Typically, it's the Bloombergs and Reuters of the world that compile these kinds of averages that then end up being the baseline of expectation for investors. And you can see that relative to those baselines, the data is looking increasingly abysmal over recent weeks. So what the ECB's job here is going to be is selling the market on this being enough economic pain as it builds over the coming weeks and months to bring that services excluding energy and food component of inflation down, such that disinflation continues and inflation expectations turn back down. If they're not able to sell that part, if they can't convince the markets that they don't need to do any more tightening because the economy is already fizzling and that will be enough, then what we end up with is, first and foremost, a stagflationary risk building into local assets and perhaps broader assets as well, because, of course, the Eurozone is close to a fifth of global GDP. So we're getting into a sense of risk aversion probably in local shares. But more importantly, and more specifically, what this probably means is a harsh knockback on the euro, which has been a little bit more buoyant in recent week and a half or so, maybe 2 weeks. Because what you would end up with then is weak growth, yet unchecked inflation. And if the market can't be convinced that, in fact, it will be checked as all of this comes together, it will be the euro that is punished, because the markets end up saying, well, the ECB is going to allow the currency to be eaten at by inflation without checking it with even higher rates, even at the same time as demand for the currency is diminished by the economic slowdown. So it could very well be that in the wake of this ECB announcement, it is the euro that takes the biggest lump, because Christine Lagarde and company haven't delivered the pitch in a way that the markets end up buying. If she can sell it, of course, then perhaps we get a relatively stronger euro. Perhaps we then get a bit more confidence in these inflation expectations. But the bar is set quite high for her and for the governing council. And from the looks of it, it is the euro that will pay the price if they are not convincing enough. That's our conversation for today. Macro Money is here every week, Monday through Thursday, except this coming Monday, where we'll be off for the Juneteenth holiday in the U.S. I'm also on with Chris Vecchio, head of futures and Forex, for overtime right before Macro Money, where we discuss each day's events. And then again on Friday for Futures Power Hour, I'm on with Tom and Tony for First Call Sunday evenings. It'll be Monday evening this coming week because of the Juneteenth holiday, where neither Tom nor Tony will be there, but Chris will be, and so it'll be a macro sort of first call next week. Outside of those shows, I am opining on Twitter at Ilias Pivac. Good luck trading out there, everybody. Take care. See you tomorrow.